Hello everybody, welcome to the channel. Today we are going to talk about why does the value of the dollar change and how it affects us. The dollar. It's much more than that thing you use to buy questionable hot dogs at gas stations. It's the lifeblood of the US economy, and its value, well, that affects us all. Think of it this way. A strong dollar means your money goes further. You can buy more things from other countries, vacations are cheaper, and those imported avocados at the supermarket suddenly feel less like a luxury. But a weak dollar, that's a whole other story. Suddenly everything from gas to groceries seems more expensive, and that trip to Europe? Let's just say you might be sticking to exploring your own backyard. So, yeah, the ups and downs of the dollar matter. They impact what we buy, where we travel, and even how much that morning coffee costs. Buckle up because we're about to dive into the wild world of currency exchange. First up, let's talk about inflation. You know how your parents tell stories about buying candy bars for 5 cents? That's inflation in action. When prices go up, the purchasing power of your dollar goes down. And when inflation is high in the US compared to other countries, the dollar tends to weaken. Next, we've got interest rates. These are like the popular kids in high school everyone wants to be friends with. When interest rates in the US are high, foreign investors flock to our markets, driving up demand for the dollar and making it stronger. And then there's economic stability. Think of it like a trust fall. If other countries have confidence in the US economy, they're more likely to hold on to dollars, boosting demand and value. But if things are looking shaky, well, let's just say they might be hesitant to catch us. These are just a few of the factors that influence the dollar's value. It's a complex dance, but understanding the basic steps can help you make sense of the global economic dance floor. Remember the early 2000s? The dot-com bubble had burst and the US economy was feeling the heat. The dollar weakened, making imports more expensive. Remember those cheap flights to Europe? Yeah, those were the days. Fast forward to the 2008 financial crisis. The dollar initially strengthened as investors sought a safe haven, but as the crisis wore on, the Federal Reserve's actions to stimulate the economy led to a weaker dollar. And who could forget the COVID-19 pandemic? The dollar experienced significant volatility, initially weakening as uncertainty gripped global markets. However, it later rebounded as the US economy showed signs of resilience. These historical examples show just how much the dollar's value can fluctuate and how those changes can have real-world consequences for us all. Section 4. The big players. Fed up with global games? Now let's meet the big players in this currency game. First up, we have the Federal Reserve, also known as the Fed. They're like the conductors of the US economy, setting interest rates and controlling the money supply. Their actions can have a major impact on the dollar's value. Then there's the global market, a bustling bazaar where currencies are traded 24/7. It's a constant tug of war, where supply and demand determine the exchange rates between different currencies, including the dollar. Understanding the roles of these key players is crucial to grasping the bigger picture of the dollar's value and its impact on our lives. So there you have it, a crash course in the wild world of the dollar. Remember, a strong or weak dollar isn't inherently good or bad. It's all about understanding the factors at play and how they might affect your wallet. Now, if you'll excuse me, I'm going to go stock up on those discounted avocados while they're still affordable. Thanks for watching. See you in the next video.